Why commodity trading? Good question. Why? The reason for you to be an astute student is to know that time and money have a positive correlation, that the more time one trades, the more money can be made. But of course, with one exception, that the broker platform also increases the substantial cost benefit ratio, that time dependent strategies are necessary for enhancing the process of in the money, a call, or diminishing out of the money, a put. These are decisions that you make on a daily basis. Since with commodities, the strategies are more comparable with time-specific exchanges executed as fundamental analysis, and as a mediator using technical analysis, the trader can use leverage through more than one broker. The risk factor is minimized through small investments that accumulate over time, 30 to 60 minutes in length on a daily basis. The financial term value at risk, VAR, is a widely used risk of measure of the risk of loss on a specific portfolio of financial assets. For a given portfolio probability and time horizon, VAR is defined as a threshold value, such that the probability that the market-to-market loss on the portfolio over the given time horizon exceeds this value, which is a probability. How the course delineates the parameters and how to minimize these intrinsic and extrinsic factors through research and review of other traders, as well as a network forum, and for security or non-perishable commodities such as gold, oil, and coffee. The spot price reflects market expectations of future price movements. Several risk management techniques are deployed, and the methods and definitions and goals vary widely according to whether the risk management method is in the context of financial portfolios or project management, etc., etc., etc. Exclusive to binary options and commodities are the selected strategies to manage security as potential threats, uncertainties with negative consequences, which typically includes transferring the threat to another party, avoiding the threat, reducing the negative effect of probability of the threat, or even accepting some or all of the potential or actual consequences of a particular threat, and the opposites for opportunities, which are uncertain future states with benefits. That's what we want to capitalize on. The course takeaway, of course, is the matrix table for minimizing financial risk and maximizing financial reward. And this is on the synergy of the 7 broker times 6C model based on internal forces. As a proponent for SWOT analysis, which is strength, weakness, opportunity, and threat, and for modulating Porter's 6 forces model as a synergistic process, students can consider a creative approach which includes qualitative and quantitative strategies by identifying through similarities and differences. The matrix table, of which goes beyond the 2x2 table found in a SWOT analysis and addresses specific internal forces for the 7 broker platforms that will be discussed on. The table is innovative in design because it creates competition and cooperation by partitioning the profit to allocate a portion of the gain with another broker platform when the trader doubles an investment specific to competition, cost, criteria, cooperative 1, and 2, critical and collection as the 6 C's. The 2 main types of binary options are the cash or nothing binary option and the asset or nothing binary option. The cash or nothing binary option pays some fixed amount of cash if the option expires in the money, while the asset or nothing pays the value of underlying security. They are also called all or nothing options, digital options, more common in Forex and interest rate markets, and the fixed return options. Nonetheless, some individuals indicate that this is some form of gambling. Let me set the record straight. Once and for all concerned, a commodities exchange is an exchange where commodities and derivative products are traded. Most commodity markets across the world trade in agricultural products and other raw materials like oil, precious metals, and other commodities. The contracts are based on these commodities as spot prices, forwards, futures, and options on futures, and some are sophisticated products which may include interest rates, environmental instruments, swaps, or even ocean freight contracts. We're only concerned with commodities, and an operational definition for market liquidity is a market's ability to facilitate an asset being sold quickly without having to reduce its price very much or even at all. Equivalently, an asset's market liquidity, or simply an asset's liquidity, is the asset's ability to sell quickly without having to reduce its price very much. And liquidity is about how big the trade-off is between the speed of the sale and the price it can be sold for. In a liquid market, the trade-off is mild. Selling quickly will not reduce the price much. In relatively volatile markets, selling it quickly will require cutting its price by some fixed amount percentage. Wanting more is instrumental rationality. In other words, it's human nature to want more, which involves seeking the most cost-effective means to achieve a specific goal without reflecting on the worthiness of that goal. This course will support the supply and demand prevalent in any economic model, determined in the market. It concludes that in a competitive market, the unit price for a particular good, such as gold, or oil, or coffee, will settle at a point where the quantity demanded by the consumer, current price, will equal the quantity supplied by the producer, current price, resulting in an economic equilibrium for price and quantity. Central to the course is extrapolating on the four basic laws of supply and demand. If demand increases, the demand curve shifts to the right and supply remains unchanged. A shortage occurs, leading to a higher equilibrium price. If demand decreases, the demand curve shifts to the left and supply remains unchanged. A surplus occurs, leading to a lower equilibrium price. If a demand remains unchanged and supply increases, supply curve shifts to the right. This surplus occurs, leading to a lower equilibrium price. If demand remains unchanged and supply decreases, supply curves shift to the left. A shortage occurs, leading to a higher equilibrium price. This is what you can expect with the program called the Creative Binary Options with Commodities. And I hope that you do follow the sequence of operations, since it is critical in your thinking and action. Thank you. This is Raymond Ebler, the White Hat Specialist, signing off.